One of the final things you negotiate when you're selling a company is, the real estate lease or sale of the real estate. And, sometimes it can be a sticky wicket that's overlooked at the beginning of the process. But you really have to address it head on to find a solution that works for you so you can get to close. Hi, everyone. My name's kdee, President of Osage Advisors. Welcome back to our podcast, The Ins and Outs of Selling a Business, and this week's big hurdle. So, the real estate question, we just finalized a letter of intent with the company. And, in our book, in our SIM, we put in, how do you want to treat your real estate? The owner either wants to lease it under a long-term lease agreement or sell it or open or options. So when we sit with our client, in this particular case, we sat with our client early on. We looked at the real estate lease, and it was a related party. It means that the company's ownership also owned the real estate in a separate entity. And we determined that the rent being paid was less than fair market value. So when we put our book together, we accommodated for that. We had a negative adjustment, right? A reduction of profit to bring the lease up to a normal level. So, if a party came in and signed a long-term lease, this is current fair market value. So we went out to market and we got a number of letters of intent. I think it was close to 11 or 12, and some had the real estate, owning it, buying the real estate as part of the deal, and some had it as lease, as renting the deal. So we sat down with our client, we looked at it, and he said it's kind of hard to evaluate them in some regards because it's not apples to apples, right? You got one buying the real estate, one leasing the real estate. So we went back to the parties who had put forth letters of intent buying the real estate, and we asked them to resubmit under a lease deal, right? Would it be maybe lease for 5 years with an option to buy, first right of refusal? We had an open dialogue with them, and so this was probably 4 or 5 of the parties, and a couple dropped out. They said, look, we only want to do because the real estate's involved. And the main reason is they're looking to most likely leverage that real estate to finance the purchase of the business. And they want to hold on to that as a potential asset of the company moving forward, whether they do it themselves or sell leaseback, whatever. But that was determination. They're going to move away from this transaction. So, but we had several parties, resubmit on a lease basis. So now our client can look at it as if I sold it with the building and if I just leased it. And so we went back and forth. We had many discussions, what made sense. And at the end of the day, our client decided that, I think I'd like to keep the real estate. It's cash flow. It was an industrial building, so it's a highly desirable asset long term. And in the short term, if I can enter into a lease agreement, that could be what we call investor lease, meaning that it's say a 10-year lease. That if I decide I want to sell it, I can sell it, but I want that flexibility. I want the cash flow from the lease on the building. I want the flexibility to sell it, and then in 5 years from now, the current company that's going to buy the business will have an option to buy the building at that time. If we decide that our client decides they want to sell the building earlier, they have first right of refusal. And our lawyers, part of the deal, are drafting a lease agreement. Who's responsible for what? Make sure you have a good, strong real estate attorney involved. But it was like the best of both worlds. So it wasn't like we approached the engagement. Well, you got these guys that want to buy it, these guys want to lease it. I said, let's get them all on a level playing field, either or, and see what the valuations come in. And the one that really struck to our client was a company that was very strategic in nature. They were at the top of the list anyways, but when they came back on our lease agreement, it was very, very intriguing and got our client excited to do it this way. So from our perspective, there's many situations where the real estate comes into play, and you have to make sure that you hit it head on early in the transaction process, whether you need to, build it back up to the fair market value rent, so that's properly reflected in your financial statements, adjusted financial statements. It could be you could have a rent that's higher than fair market value, so you have an add back, right? So improve your earnings, or one that's at fair market value, so it has no effect, or you have one that's below fair market value, so you have to kind of reduce your profitability, because a buyer's going to look at it. If I'm paying fair market value going forward, then even though you're showing maybe $2 million of EBITDA, it may be $1.8 million, $1.9 million of EBITDA when I get to a rent agreement based on fair market value. So really pay attention to the lease, really pay attention to the real estate component. Give it a lot of thought that what's important to you on that piece, because it's going to come up, and it usually comes in, the final decision on real estate usually happens towards the end of the transaction when everybody's kind of, exhausted from the whole process. But if you hit it head on, have a clear guideline what you want to do with the real estate, it will help smooth out the transaction process to get it to close. Thanks again for being with us today. My name is kdee, President of Osage Advisors. If you enjoyed our podcast, Ins and Outs of Selling a Business, please feel free to like it, subscribe to it on our YouTube channel. To learn more about Osage, you can visit our website at osageadvisors.com, or shoot me an email at kdee@osageadvisors.com, or pick up the phone and give me a call at 860-767-3273, extension 1001. Thanks again for being with us, and have a great day.